All right, welcome to the execution month, where the first video that we are going to go over is time. Because before I dive into my confirmation time frame, or I want to confirm a PD array, I always want to make sure time is actually agreeing with the ID. So we need to have price and time and price in alignment with each other. So right here, moving on to the first slide, we see again, little reminder, foundation levels right there. We have gone over bias, we have gone over narrative, we have gone over the boundary, the context right there, and the target context. Now it is time to go into the entry right there, but just before we dive into the entry, we need to go over time as well. Then after that, of course, we go over risk management. So the foundational levels for the execution month are entry right there and risk management. Now, I have noted right there, the first thing that we go over in the entry phase right there is again time, because we need to have time supporting the ID if we want to do anything at all. So time, what actually is it? Again, for me, when I came into trading, when I learned about time personally, it was always super mysterious. As in, people mentioned time like it was some magical time where everything would work out and something magical would happen in the chart. It's not that deep. It is simply volatility in the market. It is simply energy, as I like to refer to in the market. If you want to make a move, if you want to jump, if you want to sprint towards something, then you need to have some kind of energy. Otherwise, that's not possible. Otherwise, you would be laying down on the floor without any energy. You would not make any movement at all. That's the same with the market. If the market doesn't have any energy, it's not going to move higher. It's not going to move lower. It's going to stay in the same exact place. It's not going to be fruitful price action. It might consolidate. It might take us out first before it actually makes a significant move higher or lower. The way I like to refer to that as well is whenever we have price agreeing. And what I mean with price agreeing is simply not looking at time. So not anything that has to do with time, simply looking at the chart. Do we have context? Do we have the narrative? Basically all the things we went over thus far. If we have price agreeing, that does not mean it's necessarily always going to be a good trade. Because if we only have price agreeing and we don't have time, we don't actually have the underlying factor of that volatility coming into the market, then the setup might be there and it might seem like a good setup, but that is going to be a trick. You're going to get tricked into the market most of the time. Again, all based on probabilities. You're going to get tricked in the market most of the time, and then it will consolidate, or it might take you out, might hit your break even. It's not going to move till you take profit. And from a logical perspective, if we target a 1 to 2 RR, if we want to hit our 2 RR, take profit, then what does price need to do? It needs to actually move. It might sound very logical, but oftentimes it's an overlooked aspect right there. Now, it's quite important as well that this is probability. So the days that are low probability or high probability, sometimes we will still lose on high probability days. Sometimes we will still win on low probability days, for example. It's all probabilities. So please remind yourself of that as well. When we have a low probability day and we see a great trading day right there, we have great setups price-wise, that does not mean it's actually a good day, because it might just be 2 good days out of 10 bad days, for example. So the probabilities are not in your favor. Very important as well. So there's 2 types of time. We have the higher time frame time right there, and we have the lower time frame time. First, it's important to understand, number 1, higher time frame time. It is a hierarchy right here. So the higher time frame time is more important for me than the lower time frame time right there. Higher time frame time is volatility on the higher time frame. So monthly, weekly, daily, 4 hour. That's where we have volatility seen on the higher time frame. So how do we know if a daily candle actually wants to make a significant move, if the next daily candle can actually be very volatile if we have time supporting the ID? So what is the time factor on the higher time frame? This is seen through the economic calendar. So higher time frame time is going to be news events. It's economic calendar related. Then next we have lower time frame time. Lower time frame time is volatility on the lower time frame. So that is the 1 hour, the 50 minute, the 5 minute, the 1 minute. So if we want to know if the 1 minute candles, the next few 1 minute candles, actually have some volatility in them, if they can actually make a move higher or lower, then that is seen through the kill zones and also the sessions. Again, kill zones is almost like this mysterious thing where we have this magical time. The way I learned about kill zones was, well, I learned about it and then I would just take any random trade within that kill zone, just hoping it would magically play out, because I thought, and it was introduced to me like it was some magical time as well. And that's just not true. That's just not it. It is all about certain sessions as well. Now, the way I want you to see sessions as well, it is not something opening. So a lot of people think London Open, for example, London Open kill zone, is actually London opening, as in there's traders that come to their desk during London and they make the market move all of a sudden. That's not how it works. Orders get filled at that time. Now, the reason that's important to understand is because everything runs off of New York local time still. So when you have a daylight time shift and the time changes, the time does not actually change. It always stays New York local time, always. And that is because that is why it's called kill zones, because that is when orders, bigger orders, actually, they get filled. That's when the algorithm who fills orders for other people starts working. That's why it's called a kill zone right there as well. Now, first things first, of course, we need to go over higher time frame time. Higher time frame time, I've noted a few things right here. Higher time frame entries. If we want to take higher time frame entries, we need to make sure we have volatility supporting the ID right there. So if we want to take a daily or 4-hour entry right there, then we need to make sure on that day that we actually take that daily entry, we want to have some kind of volatility. I like to think of it as we want to be surrounded by volatility. We had volatility and there's new volatility coming into the market. I like to see it as a boost in a game where if you have played certain games, and it can be any game, that involves some kind of boost, and I'll visually describe it right here. Then when you take a boost right there, we move higher. And then you have no boost, so you slow down a little bit right there. And you slow down, and then a new boost. You drive into a new boost or you approach a new boost, and again, you can continue higher right there. It's the same in the market. And every time that boost happens, that is higher time frame volatility coming into the market. So if we want to continue lower right there and we have significant moves lower, significant boosts lower, then that is the economic calendar news event. So we are essentially trading within those boosts. Can we survive until we reach the next boost right there so we can again continue higher, for example? Then we have lower time frame entries. If we want to take lower time frame entries, we need to make sure we have higher time frame volatility for that day. So for example, Euro US dollar, if you want to take a 15-minute entry, then make sure you have some kind of higher time frame volatility supporting the ID. Again, why is that important? Because if the daily candle wants to actually make a move, if the daily candle actually wants to continue higher or continue lower with a volatile day, then that's not going to be done through sessions and kill zones. They are too weak. They are too weak to make an actual significant move, with the exception to that rule, indices, because the indices kill zone is not too weak to make that significant move. But for Forex, for gold, for silver, for example, it is very important to understand that the higher time frame moves will happen because of higher time frame volatility. The higher time frame moves, a daily candle moving, a 4-hour candle moving, does not happen because we have lower time frame volatility. So on average, you can see this for yourself as well. If you use any volatility indicator, and what I mean with that, one I like to use right here is marketmilk.babypips.com right there. And you can search for symbols right here, and you can see the volatility that we had throughout weeks, throughout the past year, etc. And if you compare the days where we do have news, then you'll see those days are more volatile. The average movement on that day is higher. Why is a Monday, for example, volatility per day right there, last 30 days, all days, why is a Monday less volatile overall? Well, usually we tend to have less news on a Monday. The economic calendar news comes in later during that week most of the time. So that is why is oftentimes advised to trade Tuesday, Wednesday, Thursday, because that's where we have the most significant news throughout the week as well. Then if we move on, we see right here US dollar. And for the US dollar, for Forex Major, anything with US dollar in the ticker name, I want to see US dollar red folder news. So remember the forecast list, this list right here, for this whole list, for the metals right there, for Forex list as well, indices again, exception to the rule. For Forex right there, for metals, I want to see US dollar red folder news ideally. Now, before I show you what that looks like, there is an exception to that rule. There is a big 3 news event right there. Big 3 news events are CPI, FOMC statement, and NFP right there. Those are an exception to the rule because they are extremely volatile. And when we have so much volatility coming into the market at a certain time, before we actually have the volatility coming into the market, we will most likely already consolidate. So the price action before that will be low probability. So we have a rule for the big 3 news events where the day before you do not want to trade it ideally. And the day itself before the news release, you also do not want to trade that. So let's go over a few examples. If we take a look at the current week that we are in, we see on Sunday we have some bank holidays. Monday we have some bank holidays right there as well. Then we have US dollar red folder news right there and US dollar orange folder news as well. The red folder news for me is the important one. Orange folder news for the US dollar on its own is not significant enough for me. I always want some kind of red folder news. Now, I say some kind of red folder news, but right here later on a Friday, the first Friday of every month, we have NFP right there, non-farm employment change. So it doesn't actually say NFP, it's non-farm employment change right there. That is where we have a lot of volatility coming into the market at 8:30 a.m. New York local time. So the day before, even though we have US dollar red folder news right there, I want to be more careful because I know we might actually consolidate the day before and the day itself before we have the 8:30 news release right there. Now, after we release that news of NFP, you can look for a trade. So after the news release is coming into the market and the volatility is actually there, that's exactly when we can look for a trade ID. Now, it's also important to understand that Thursday ahead of that NFP news release right there, that's also when we can potentially look for trade IDs. But this is something I'm going to go over in later videos as well. So for this particular week, this already tells me that I mainly want to be looking at trade IDs at the beginning of the week right there and not at the end of the week most likely. Now, for those big 3 news events, we always have a 1 day extra. And what I mean by that is after NFP, after CPI, after FOMC statement, the day after is also volatile. So if we don't have red folder news, for example, in after FOMC, after CPI, see if we can find something. Let's say on that Thursday right there, we don't have US dollar red folder news, which sometimes will happen. But on that Wednesday, we have FOMC statement right there. Then that Thursday is still perfectly fine to trade because the day before, you do not want to trade right there, we might consolidate. Ahead of FOMC, we do not want to trade, we might consolidate. After FOMC, it's perfectly fine to get involved. Then that Thursday is already going to be more volatile because we have FOMC and we have had FOMC statement right there the previous day as well. So that is quite important to understand. If we don't have any news supporting the ID, the next day right there for the US dollar, red folder news, but we do have a big 3 news event the last day, then we can look to trade that next day because there's volatility carrying over towards the next day. It's again, that boost that we constantly have. We're still trading that boost of energy that we have from the previous day. Then we move on to the crosses because for crosses, anything without US dollar in their ticker name, I want to see a minimum of orange folder news. So what are the actual crosses? On this list right here, a ticker name is, for example, Australian dollar, US dollar. That's a ticker. That's called a ticker. And that ticker name right there is Australian dollar, US dollar, and it has US dollar in the name right there. So anything that does not have US dollar in the name right here is, for example, Australian dollar, Canadian dollar, Australian dollar CHF, Australian dollar JPY. the crosses list right here discussed as well in the previous video actually. So right here, it is important to understand that these are less reliant on the US dollar. So for example, if we do not have a lot of volatility coming into the market for the US dollar, but we do have a lot of volatility coming into the crosses, for that week, it might be more interesting to actually take a look at the crosses instead. Oftentimes, the crosses, and as a general rule of thumb, the crosses are going to be less volatile than anything related to the US dollar in the actual name. So Australian dollar, US dollar, New Zealand dollar, US dollar is always most likely going to be more volatile than anything to do with the crosses. But sometimes the dollar is not clear. The dollar doesn't have that volatility. The dollar is consolidating. That's exactly when we can take a look at the crosses. So there's a hierarchy right there, and I hope you can see that. Well, I would always prefer to trade the Forex majors. So again, that is the forecast list. I would always prefer to trade here Australian dollar, US dollar, EU, GU, anything to do with the US dollar. But if the US dollar is just not clear, I can't get to a clear drawn liquidity, there's no news supporting the ID, then I want to switch to the crosses right there to take a look at the crosses as well. So for the crosses, how do we approach this right here for Forex Factory? Again, the way I have set this out, my filters, is the following. On the top right there, we see I have red folder news, orange folder news. I only don't have a yellow folder news right there. Now, yellow folder news is only relevant to me in one scenario, when we have crude oil inventories. So that's what you'll see in yellow folder news. So for example, last week right here, we had crude oil inventories right there for the US dollar. That will impact crude oil on the higher time frame right there. So it's only relevant for crude oil. But for the rest, I leave it off right there. I turn it off because it's not relevant to me. Now, if we want to take a look at the crosses, then what we can do at the beginning of our week, and this is what we did in a previous video, actually the analyst month, the 12th video, is we take a look at the economic calendar and we see, well, on what days and what kind of news do we have supporting the ID. Right here, we take a look and we see, for example, on this week, we had Australian dollar CPI right there. We had Australian dollar red folder news. CPI for the cross pairs is tradable. Yes, of course, it depends on the actual context. If you're about to take a 1 minute trade and you are about to execute with a 1 pip stop loss, for example, yes, be careful with CPI. But anything with a 15-minute entry or above, as a general rule of thumb, is perfectly fine to enter during CPI for the crosses as well. CPI for the US dollar, no, that's a no-go. Then just wait. Now, right here, if we are looking at a euro ticker name, for example, Euro Australian dollar, that's also perfectly fine to trade. For Australian dollar, for New Zealand dollar, for JPY, you will notice those news events are late during the day. So we see JPY 7:30 p.m. New York local time. For a New York local time, it's late during the day. For 8:30 p.m. right there, also late during the day, right? So that day itself, the Tuesday itself, and the Wednesday can be traded when it comes to Australian dollar. Same for the Australian dollar right there, retail sales. Wednesday will be volatile, but also that Thursday right there. For JPY, same thing. Thursday, but also that Friday right there will be more volatile. So for this week, we have Australian dollar, we have euro, we have Canadian dollar right there, and we have JPY. So for the crosses in that particular week, the ones you want to focus on are the ones that in the ticker name, they have Australian dollar, euro, Canadian dollar, or JPY right there. If it's GBP JPY, that is still fine because you have the JPY part of that ticker name still supporting the idea of having volatility. Now, if you have euro Australian dollar, then that is absolutely perfect because you're going to have double the volatility. You're going to have euro and Australian dollar news volatility right there coming into the market. GBP Australian dollar is also perfectly fine, but most likely it will be less volatile than euro Australian dollar because euro Australian dollar has again that double volatility, where GBP Australian dollar has one volatility. Now, GBP New Zealand dollar, no, that's not good because we don't have any news event for GBP or New Zealand dollar throughout this week right here. So that's not something I would want to trade. So if we are looking at higher time frame entries right there, we again know what news to look at. Now, for higher time frame entries, big 3 news events are perfectly fine to trade. So if you're taking a 4-hour trade, if you're taking a daily candle trade, for example, that is perfectly fine to trade the big 3 news events as well. So before that, during that, whatever it may be. Lower time frame entries is where you want to watch out with the big 3 news events, where the 1 hour is debatable. Because in certain contexts, yes, the 1 hour can still be traded ahead of big 3 news events as well. Because oftentimes it's almost like a 4-hour entry. So that really depends on the context. But if you're taking a 1 hour trade, for example, where the stop loss is only 3 pips and it's acting like a 5-minute trade almost, then yes, of course, be careful with the big 3 news events. There's not one specific mechanical rule on that, but it takes some logic and not necessarily experience, I would say, because it's just purely based on how big your stop loss actually is. Is it very reasonable? Is your stop loss very close before you take a big 3 news event trade right there? Even if the 4-hour stop loss is extremely close and you're almost suffocating that stop loss, then still you would also need to watch out right there. Now, once we have a higher time frame time supporting the ID, we can move on towards the lower time frame time. And with lower time frame time right here, we can lower time frame entries, we need to make sure we have some form of higher time frame volatility. Again, exception to that rule, indices. Well, for me, indices are always fine to trade. As in, if the price action is nice, then we have enough volatility coming in at 9:30 a.m. at equities open. Equities open is 9:30 a.m. for the indices. So if we have red folder news right here for the indices at 8:30 a.m., we can already trade at 8:30 a.m. New York local time right there. Every time, whenever I refer to time, whether that be in the Discord, whether that be in a PowerPoint slide, whether that be in a random video where I do not mention AM or PM or whatever it may be, or New York local time, I'm always referring to New York local time at every single time. So for the indices, the kill zones are the following. We can define them more, but from my experience, that's not really valuable. It doesn't really matter if we define those kill zones more. So for example, you might not see right here the AM session, the PM session, London Open. You might not see New York kill zone. You might not see a London kill zone or the Asia range. It's because it's simply irrelevant. It's oftentimes just simply said, again, not relevant. Now, for the indices, the time where you want to focus for your trades. If we have red folder news at 8:30, we can already trade at 8:30. That's US dollar red folder news. Then 9:30 a.m. until 4 p.m. New York local time right there. That is the time window where you want to look for trades, ideally. Again, do you need to trade that a whole period? No, that depends on your personal preference, on your lifestyle. Are you working from 1 p.m. to 4 p.m., for example, and the early morning you do have time? Perfect. You can trade the early morning right there. You can trade from 9:30 until 11 a.m., for example. Then right here, what I do mention specifically is 3 p.m. to 4 p.m. power hour. If you do not have a lot of time throughout the day, but you do have time from 3 p.m. to 4 p.m., most of the time Europeans as well, they work throughout the day, and then at the end of the day, they do have some time to potentially trade. I would always recommend take a look at power hour. Power hour is very interesting for the indices. It is called power hour because it's the bond closing hour. It's when everything, the last hour before everything closes, regarding equities, etc. So that is where if price still has a delivery to make, it will do it quite fast. The same as if the mailman, for example, still has delivery to make in the last hour of his shift, he most likely wants to do that quite fast because he doesn't want to be late, he wants to go home, etc. Same for power hour. If the power hour still needs to reach a certain drawn liquidity, or it's a closed drawn liquidity, it will most likely move there quite fast because it's the last hour and it wants to do that fast. It wants to go home as well. Now, another thing that I want to as well mention is we have lunch hours. Lunch hours, like oftentimes seen on social media, they are mentioned and you need to take them into account. They are not super relevant in the way we operate right here. And that is seen as well if we have context, for example, on the 1 hour. That 1 hour context, whether it's lunch, whether it's whatever it may be, the context will just simply look to follow through as well. And the reason for that is, again, well, I like to use logical analogies. If you are working and you have lunch coming up, but you're busy doing a task, for example, and the task right here would be if someone is trading context or looking to follow through on context, then would you first want to finish that task or would you want to go for lunch? Well, most people, and generally speaking, they tend to first want to finish the task before they go with lunch. So if we're moving from context target to now context boundaries to context target, and we're looking for entries in that, then oftentimes we will just look to follow through. So the lunch is not relevant. The price action right there is more relevant than the lunch time. Now, let's go over a few examples right here on the indices as well. When I refer to the indices right here, I'm referring to RTY, ES, NASDAQ, and YM. Again, I use the CME contracts right there. These are the futures contracts. You can use the CFDs. The price will be completely different in comparison to your prop firm, your CFD prop firm. That's because CFDs, the broker can sort of make their own price action. So the price is going to be completely different. The candlesticks might be quite similar to US 500, for example. If you want to take, or if you want to look to take the indices more seriously and you really like to trade them, I would always advise go for the CME package. Now, right here on E-mini S&P, we see that we have this fair value gap right there continuing lower, and we already continue lower off of that right there. Before 9:30, so before equities open actually starts and where the volatility comes into the market. Now, the reason that is because at 8:30 right there, we already had news supporting ID. So there's a news release at 8:30. When that happens, same for NFP, for example, also at 8:30, there's already a lot of volatility coming into the market. So equities open will just follow through most likely on whatever 8:30 does. If 8:30, for example, takes already a major liquidity pool, then most likely what happens after is that AM session 9:30 right there will actually consolidate. So the AM session right here, if the AM session consolidates, which is from 9:30 to 11 AM right there, then oftentimes the PM session will actually make a significant move. The PM session will actually be allowed to move. So if we find an example for that, then we can take a look right here. We can see that from 9:30 starts right there until the PM session starts right here almost. That's when we get the move. And that's because at 8:30 right here, it was already volatile and we already took some form of liquidity right there. We tend to sweep that, or we see a potential sweep right there, and we consolidate as well. So right here, the PM session is the one we then want to trade, which is from 1 p.m. until 4 p.m. right there. That is the one where we'll most likely see a significant move. Power hour, again, from 3 p.m., like we see right there, delivers a huge move lower right there as well. And then after 4 p.m., it starts to consolidate, where we don't want to look for a new trade ID anymore. Then from the indices, we move on to Forex right there. So for Forex on the lower time frame, for the London majors right there, you ideally want to trade from 2 a.m. to 10 a.m. New York Eastern time, New York local time right there. That is where you want to take the trade, as in that's where you want to get involved in trade. Can you hold the trades overnight? Yes, you can. If on that day where you are taking trade, you have volatility supporting ID. And if you want to hold that trade overnight and you want to, again, depends on a specific scenario, because again, if I use a 1 minute analogy, then I would say just get out of the trade. But 15-minute entries and above, as a general rule of thumb, if you want to hold the trade overnight, it's perfectly fine as long as the next day you still have volatility supporting the ID as well. If you don't have volatility supporting the ID the next day, then the next day can potentially consolidate and you'll be stuck in that trade, for example. So you can hold overnight if the next day you still have news supporting the ID on the higher time frame. Then Asia majors right there. So what is the difference between London majors and Asia majors? London majors are pairs, like it says in the name already. They are mainly going to move on London and New York sessions. That is London 2 a.m. to 5 a.m. The New York is 7 a.m. to 10 a.m. right there. Again, the specific time window is not super relevant right there. But it is relevant to know what is a London major. A London major is everything except when we have JPY, Australian dollar, or New Zealand dollar in the ticker name. So what does that mean? Asia majors are the ones where you have JPY or Australian dollar or New Zealand dollar in the ticker name. If you have those in the ticker name, then that is an Asia major. An Asia major is volatile throughout the whole day. So if we take a look at the volatility index, then here we have Euro US dollar, and we want to look at the volatility per hour. So right here, if we now take a look at the last 12 months to get a bigger sample size, then right here we see from 2 to 10 right there, we have the most volatility in the actual market. Now, the reason I say 2 and I point to 1 right there is because it's GMT -5. I am in the Bogota time zone, which is Colombia. So I am 1 hour behind on New York local time. GMT -4 is actually New York local time currently because we are in summertime as well. So it's actually from 1 to 9 for me if I'm looking at this chart. That is where we see the most volatility. After that, we see the volatility die down right there. Where throughout the night, overnight right there, and for New York local time overnight, that's exactly when we have the least volatility in the evening and throughout the night right there. But once we have that London, for the London majors again, open up, that's when we see volatility rising. Now, if we compare this to an Asia major, for example, Australian dollar, US dollar has Australian dollar in the ticker name. So it is again an Asia major. Then what do we see the volatility per hour? We see it's a lot more balanced. It's a lot more divided throughout the whole day, where you have London, you have New York, you have Asia range, Asia session is also extremely volatile. The only thing you want to watch out for right here is from 4 p.m. So for me, that's 3 p.m. right there. 4 p.m. New York local time until 6 p.m. New York local time. So for me, that's until 3 till 5 right there, GMT -5. Then you want to watch out for the market rollover. So that means if you are already in a trade, you can hold that trade. Depending on what your broker says for the market rollover, etc., depending on the prop firm, for example, if it allows you to hold overnight, that depends on certain factors as well. But as a general rule of thumb, if you're already in a trade, you can hold that. If you're just about to enter a trade, I would say wait until after the market rollover to then look to get involved again. Now for Asia majors, it's also quite important to understand, of course, are you just simply looking at the whole day and you're always at your screen, you're always at the chart to look for a trade ID? No, this is where alerts come in, which is a topic that we are going to go over on later on as well. So where an alert goes off, and that's actually a notification to now look at the chart. You're not always staring at the chart, if that makes sense. Then from Forex right there, we move on to crypto. And crypto, there is no specific time rules on the lower time frame for me. If you want, you can stick to the London majors right there. That would be my argument. If we are talking about crypto and we're talking about a specific kill zone on the lower time frame, I would argue stick to the London majors right there. The London major rule, where from 2 a.m. to 10 a.m. you can trade New York local time as well. Then for the higher time frame crypto right there, you can use Cryptocraft actually, which is quite interesting. I also recently found that out or discovered it through someone that mentioned it in the Discord actually. This is essentially Forex Factory. It's by the same developers as well, just for crypto now. So right here, cryptocraft.com, you'll see it looks the exact same as well. And for this particular week, we see, for example, all the news that impacts crypto more so. Where Forex Factory is again more focused on, indeed, Forex. Cryptocraft right here is focused on crypto. So we have quite a lot of news on Wednesday right there and on Friday as well. I have it filtered so it doesn't show the yellow news right there. You can also potentially look at the yellow news, but as a general rule of thumb, I don't like yellow news and it's not too big of an impact right there. So I stick to orange and red folder news right here for crypto as well. Then from the lower time frame time, we have talked about everything regarding time that we need to talk about right there. So again, the time is simply said, it's volatility. Never forget that, because it's not some magical time where oftentimes time, it gets thrown a lot around like it's something random, something magical. You'll hear some crazy times as well on social media, if you are active on social media, which are just simply irrelevant. These are the most important times and the time windows where we actually want to look for a trade ID as well. So my advice is practice. Mark out significant moves in the market. See what the underlying factor was, time-wise. So how would that look like? Any given market right here, you can even look at the crosses right there and go over Canadian dollar CHF, for example. Then go into the daily or go into the lower time frame. Again, depending on the time frame that you're looking at, look at how we actually delivered there. Are we looking at a kill zone or are we looking at economic calendar news? For example, the expansion phase candle right there. That's quite a volatile day on Tuesday, the 26th of March. So was there any new support ID? There might not be, right? But most of the time you'll see that there is new supporting ID. So you can also do the opposite, right? Where on the least volatile days, do we have any new supporting ID actually? We might not actually have new supporting on those IDs right there. So that's a good study to do. For example, if we want to continue higher right here of that daily value gap, then you can also study, well, on which day do we actually have the volatility coming in? Do we actually have a session right there, which we can also look to continue higher from, etc. Study the time right there. And then the next video, we can dive into the technicals to see what it looks like actually from a technical price action perspective. All right, perfect. Thank you.